Hello, welcome to Macro Atlas. So today Bitcoin is crashing. The stock market is a little bit crashing as well. Gold is destabilizing a little bit, and oil is increasing its upward trend. And I think that's mostly due to the factor that America has laid out a lot of they have sent a lot of units to the Middle East, and they are preparing for some form of ground invasion to Iran. So that's an earlier pricing for a regime shift that might happen. Now, in a previous video, we did talk about what can oil do to markets if it stays elevated, because it can actually create a lot of risks. And when oil increases, that means the shift there's a possible regime shift that is happening, and this is where the opportunities come to be positioned early, or at least be prepared for if the markets move, you understand what's happening, right? So yes, I'm just gonna show you kind of what I mean with the regime shift. So previously, if we go to oil, right, oil used to play within a different range of price. Okay, in the I had it like more better lined out in a different way. If we take the fib channel, that would be better seen, right? Let's take a fib channel and put it right here. And you can see how we are being elevated now a few fib channels up. So previously, before the war, we were in the $60 to $70 range. But right now we are playing with the 85 to $100 range per barrel. Okay, and that's very important. Because if you do some research, then if prices actually stay elevated at these ranges, then we get some kind of pressure on the economy, especially if the economy is not strong, then it cannot absorb that pressure due to inflation risk. For example, if inflation were to rise, then the Fed would be less likely and more hawkish on reducing interest rates. And once oil have expanded the way it did, then we just saw the tone of the Fed became more hawkish, and they delayed any rate cuts this year to next year. Maybe there's one or two rate cuts this year being priced in by investors on based on probabilities, but you can see that the tone has shifted in the market, and that was priced out in the stock market. And uh, Bitcoin did not, because I think the the thing that moved Bitcoin up or stabilize it within the range is if there's always a theory that works out, right? Um, if you lose trust in the government system, and if you think that banks cannot hold your money, for example, I would believe a lot of Iranian people would have moved their money from fiat to Bitcoin, or from US dollar to Bitcoin, if they are tech savvy, because they saw that Iranian currency just fell off a cliff, and if they hold USD assets, whether abroad or in the country, there's a risk they cannot convert that to any usable money, right? So at the start, I think the theory that Bitcoin is a currency that is moved through deep trust in in the financial system or the governments usually works out. But there are more bigger forces in play that Bitcoin also considers in its price action. For example, liquidity, and being perceived as a risky asset still, because it is young. It is not a mature asset, right? So if oil prices, and as we speak, Bitcoin is literally breaking down from the confirmation level. If we do a daily close there, my conviction that the breakdown of that consolidation phase is more likely. If it's 3 day, I would increase my conviction. I basically work in probabilities, and if it's a week, then I would definitely increase my position. Before we continue, I'm Mo. I'm a computer and data scientist, and I've been a crypto and macro markets speculator for the past 7 years, and I was able to turn a humble portfolio into six figures this cycle. So if you would like to learn some of my strategies and how I think, and basically I have a macro theory that sets my directional bias, and I use technical analysis to set my entry points and exit points and take profit points. In previous videos, we were able to, for example, capture right here the downtrend, and at least I was able, and I hope if you watched some of these videos, you would have took the warnings that this may be the trend exhaustion, and we may be entering the consolidation phase. based on analysis of previous bear markets and probabilities and recency bias as well. I use a lot of recency bias. One of the recency bias methods you can do that is very simple, but rarely anybody uses it, and you get that, and then you might get the range, right, of the leg move. So with that said, today we're going to be discussing the theory that if America were, and Israel, but possibly right now America alone, to use their military units that they sent to the Middle East and invade Iran through on boots on the ground, then there will be a major regime shift. Okay, and I'll explain why. Regime shift considers oil. If you get American boots, and let's maybe increase here because we're gonna be talking for a while. If America were to send boots to Iran, and that's the macro part of it, right? And that's the macro part of the trading strategy, why we think Bitcoin is going down. Then the market will start to reprice that de-escalation is less likely and escalation is more likely. And why is that bad? That is bad because of oil. Everything is centered right now around oil. Before, the markets were more, let's say, focused on rates and unemployment and stuff like this. Now we have an additional factor in play that affects the whole thing, including employment and inflation, right? So it plays out in the whole thing. If there are boots on the ground, that means the conflict is less likely to be resolved within the next few months and might likely actually in the next few weeks even. And because here month is dangerous, right? If oil price stay elevated for months, it's dangerous. It's very dangerous for economies around the world. So if we get an elongated war, let's say we price in a few more months of elongated war and we stay at these levels, then if it stays on this level for maybe 2 more months or 3 more months, then this will start to show in core inflation data, okay? And that will make the Fed, especially in America, more hawkish and more likely to destroy any hopes of interest rate cuts and maybe even increase rate cuts. But that's also dangerous. When the last time we had in the 1980s, I believe, a spike in oil and the Fed actually raised interest rates and that caused a big recession that happened, right? So let's hope that the Fed does not raise interest rates because that is a possibility, especially if oil prices increase above the 100 level. 100 to 120, that is big pressures, like it's a macro stress zone, okay? And the odds of recession, if prices stay elevated there for a month or two, it goes up to 60 to 80%. But if we go even beyond 120, then this is a crisis and it's a stagflationary trigger, all right, based on history and the range we were at and where we're now. So if usually oil price goes up by 20 to 30%, that is considered dangerous. And if more than that, then that is considered very dangerous. The regime here was oil prices below the 70 mark, okay? And now we switch to two regimes up. So we're between the 85 to 100. And the markets repriced the initial spike as a spike. We don't know if the war will end soon or not. But if it stays, that elongated price, even at current levels, stays for a longer period of time, then the market will start to reprice a regime change from reduced liquidity in the market, from more hawkish central banks around the world, from increased inflation risks, from increased recession risk. And hopefully if we go above that level, then we will start to think even of stagflation risk, which is even more dangerous than in recessions. So recessions, you only get slower growth, but the stagflation, you have high inflation and slower growth. So the Fed's central banks around the world, their hands are tied. They cannot increase liquidity because if they increase liquidity, inflation will go up. And inflation is already going up from increased oil prices. So the Fed cannot ease the economies. The economy will have to go out of its misery and condition the Austrian way. The Austrian way. So right now, we all central banks around the world. I don't know if that's relevant, but they operate under the Keynesian economy way, where if we get a recession, then we should boost liquidity in the market. Right? When good times are good, we stop increasing liquidity in the market. But central banks don't do that. They just keep pumping money, and that's why we have the problems that we have today. I am a believer of the Austrian economic thinking, which is many of the market speculators. And I believe the smart economists are in that bucket. But in universities, they don't teach you the Austrian way. Maybe they touch on it a little bit, but governments around the world, they want you to be Keynesian. They want you to believe in that increasing liquidity and degrading fiat value is the way to go, which is why we have Bitcoin, which is why I'm a Bitcoinist, and I do not believe in increasing liquidity in the market. I believe the economy should do what it's doing, the Austrian thinking way. So with that said, now we have the macro thinking, right? So if America, that's one theory. We're not saying they will put boots on the ground. We're not saying that maybe they put it for a few weeks and pull it out. We're saying if they put it on the ground, the market is more likely to reprice that the Strait of Hormuz will be closed more, and the energy crisis will be staying for a longer period of time, which will directly influence the Fed, how they think about the economies and liquidity around the world, and therefore it affects risk assets such as Bitcoin and the stock market. The stock market is going down for sure. Bitcoin has a little bit of strength in that we lose trust in the economies and fiat and governments, and therefore we might sometimes get boosts here and there every initial war. But nevertheless, major factors will take their course, and market will reprice decreased liquidity for risk assets such as Bitcoin. That's the theory. Of course, nothing is financial advice. It's for educational purposes only and from personal research. So what I'm showing right now is just my research notes on investments that I take and things that I plan. So if we actually close below here, that will get one more confirmation for me, right? Especially if it is a weekly close. And if we make lower lows, then that will be trend continuation, and we're more likely to reach levels such as the 46,000 or the 48,000, right? And maybe I'll say why those targets are in different videos, but right now those are the targets I'm actually looking for. But if we go above the rejection zone and especially in validation zone, then I'll turn more bullish and I'll see why what factors are actually in play in here. And it is pretty coincidental and nice to have the VWAP, which is this indicator that I really like. I hope maybe I can show you on this chart more clearly that. So the VWAP, that's a volume weighted average indicator that every time it collapses, I noticed that the market has a major move, such as the previous one on 5th of January. Well, it was 1 January, but this is weekly, right? It's very interesting. Even prior to that, we got the clap in the volume. So the volume collapse because it's compressed, and therefore we get an expansion after volume compression. That's the theory behind it. So usually when you get volume expansion, usually there's a period of contraction after, but after a good contraction period, you have an expansionary period, and that's what that indicator does. And that indicator is set to collapse around the 1st of April. Around there, right? I'll show you some more examples of how I place my trades is usually around the VWAP because it's just such a good timing indicator. In this video, we're trying to time the market. Of course, nobody can really time the market, but we can get pretty damn close if we try. All right, if you don't try, you'll never get it right? So that's why we try. And surprisingly, we did it a few times very correctly. You see here, sometimes we compress, but you just get a continuation of the trend, but that is pretty rare, such as here. Here we went up, here we went down, here we went up. It doesn't really tell you the direction. That's based on your microanalysis and bias that you set for yourself, but it just gives us a good indication of when such a move could happen. And here it happened as well, and here it happened as well. And if you go back and backtest it even further, you will see the same results. That's why I am very, I think it's a time to be vigilant in the market and careful, whether you're bullish or bearish or waiting to accumulate or want to offload some of your Bitcoin. Signs are showing that escalation is more likely than de-escalation, especially if assets right now are just hyper focused on the conflict that is happening in the Middle East and the oil pricing. Markets are forward looking, so the visible signs will be when oil inflationary effect takes course into headline inflation, which is set to release next month. So if that is higher, then we are more likely to see a persistent and not a temporary energy shock. But when really the signs of inflation starts to show up, so inflation first hits, of course, headline inflation because it includes energy in the calculation, but core inflation is the indirect hit, right? Not interest rates. So that's headline inflation and that's core inflation. Okay. Because inflation risks are only very, that the economy feels it when it's translated into core inflation, which does not include energy in its calculation. Because energy is used to produce all goods and services and transportation and all that, right? So it takes time for some producers will just absorb it if it's temporary. But if they have extra stock as well, right? And stuff like that, they would not pass it to consumers right away. But in 2 to 3 months, they do pass it to consumers, and that will be reflected in core inflation data, which is usually too late. All right, you might not capture the full move, or the move might stop by then. I would not believe it would completely stop, but markets are forward looking. And this is one of the last pieces of data to confirm that there is a trend shift, especially if it comes too hot. Therefore, I believe that market might reprice. This is not a sure thing, but will highly likely, if not already, repricing the boots on the ground and the higher escalation risk and the energy shock being persistent rather than temporary. I hope you enjoyed this video. If you would like more content like that, where we consider both the macro view and the technical view, please like and subscribe, and I'll see you in the next one.